So, so I want to welcome every one of you once again to today's class. So this is where we ended the class last week. We looked at the major and the minor currency pairs, and it was a very participatory session as um you were all part of the class. So thank you for that. So what we want to look at today, okay, we're going to start with the bid and the ask price today. So it's really very important. This is what measure the risk involved in your trade. All right. Okay. So when you want to trade whatever instrument you want to trade, okay, you have two prices. Okay, you have two prices. So the first price is what we call the bid price, and the second price is what you call the ask price. It's just like your normal buying and selling price when you go to a traditional market. So you go to a market. So the seller is going to tell you, this is my selling price. All right. And that is going to be your own buying price. Of course, you can negotiate. All right. But at the end of the day, that is going to be a price. And that price, you're going to have the price at which a buyer is going to buy, and then the price that a seller is willing to sell. So in the financial market, you have two prices. The ask price is the price that the broker is willing to sell to you. So this is like the selling price to you, and this is the buying price. All right. So you can see that there is a little difference. Just like when you go to the bureau de change guys, right? People that exchange naira for dollar, and you notice that they have different prices, right? Am I right? They have different prices, right? So they have the buying price and the selling price. Which one do you think is more? So from the let's look at it from the angle of you who want to transact with a bureau de change company or bureau de change guy. Which of the prices do you think is going to be higher? Is it the price you are buying from him or the price you are selling to him? So let me get that response. So which of these prices do you think is going to be higher? So is it going to be the price that you're selling to him, or you're selling to him, but the price you're buying? Because everybody that visits the bureau de change guy, it's either you want to sell, let's say dollar, of course it's dollar. It's either you want to sell your dollar, or you want to buy dollar. So which one is going to be is going to be higher? Is the price you're selling or the price you are buying? So I have a Undu best says the price that we are buying, of course. So the price that you are buying is definitely going to be more than the price that you're selling. So it's the same thing here. So the broker at Grove Exchange is, standing, okay, in that gap of the bureau de change people. Okay. So the broker connects you to the market, and then you have the ask price and the bid price. So the ask price is their selling price and your own buying price, while the bid price is their buying price and your own selling price. So the little difference is what you have here, and that is what we call spread. So spread now is the profit that the broker make. So like Grove Exchange, that is the profit Grove Exchange is going to make. Because if you ask me, okay, why is this guy teaching us this thing for free, something that normally we're supposed to pay for? Why is he doing this? Okay, it's just because that Grove Exchange want to have traders who will be trading on their platform, making money on their platform, generating this spread for them. Okay, so because that is just it's really very minute, very, very tiny. But if they have people who are trading every time and they have a whole lot of people, okay, they are definitely going to be in business and make their own profit as well. Why you make your own profit when the price appreciates when you buy or depreciate when you sell. So that's just the way it goes. So that's bid, ask, prices, and the spread. So let's look at what we have next. Okay, so there is one other thing that we call the swap and the rollover fee. So what we are doing here now is we're trying to talk about the charges, right? It's just like every other market you go, there is always going to be the charges. You'll never going to be able to buy the wholesale price. You might even pay somebody who will help you carry those things that you buy from one place to the other. You're going to pay for transportation and all those things. So it's just like every other market. So that's now what we call the swap or the rollover fee. So this one is only applicable to trades that are being carried overnight. So that means you open a trade today and you want to hold it to the next day. So you're going to there's going to be a rollover fee or what we call a swap fee. So the thing about swap or rollover fees, it could be positive for you or negative for you. Yeah, it could be positive or negative. So a forex swap is just basically the interest rate differential. When you're trading two currencies, you know the currencies we're talking about. When you trade the currencies, we know we established the other time that the central bank, when we're talking about the different participants we have in the market, we said that the central bank is the custodian of these currencies. Yeah, it's just like their home thing, they're like their property, so to speak. Okay. So when you are taking a trade over the night, it's like you're swapping. That's what the market understand. Okay. It's like you're swapping one currency for the other. That's the way currency pairs work normally in the market. So if the currency pair that you are buying, if the interest rate of the currency, let's say, let me give us an instance. Let's say you are trading euro USD. So you have the euro as the base currency, and you have the dollar as the counter currency. All right, you have the euro as the base, and then you have the USD as the counter currency. So let's say the European Central Bank currently, recently they just increased the interest rate by 0.5%. So that means if the interest rate for the euro is 0.5%, for example, I hope we can see what I'm trying to show. And let's say also that the interest rate for the US dollar is 0.25, all right, percent. And okay, of course, let's just use the current rate. So the interest rate in the United States economy now is about 2.25%, which means that we can see the clear difference between these two. So if a trader buys euro US dollar, okay, when you buy euro US dollar, what happens is that you are going to be paid the interest rate for euro because you are buying the euro. But you know, when you buy the euro US dollar, you are buying the euro and simultaneously selling the USD. That's what it means. All right. So you will be paid 0.5% as an interest on euro, and then you will need to pay 2.25% as an interest for the USD. So the interest rate differential here is minus 1.75%. So that means for a trader that buys the euro US land, carries it over the night, is going to pay what we call swap fee or rollover fee. Okay, meanwhile, these things are really very, very tiny. I Most traders don't really think about them that much because they're really, really very tiny. You don't even notice it. Okay, but it's still really very important that you know about them. And on the other hand, if another trader sell euro US dollar, for example, so what such trader is doing is that is selling euro and simultaneously buying US dollar. That's what it means. So such a person is going to have a positive interest rate differential of plus 1.75%. So that means the person will be paid swap. So that means swap can either be positive or negative depending on the direction of the instrument you are trading and the interest rate differential. Okay, the direction of the currency pair you are trading and the interest rate differential that exists therein. Okay, so that's what we mean by swap and rollover fee. All right, so this is the formula for it. So swap is a p value multiplied by all this. So don't worry, we'll still come back to this at some point. Okay, so you understand what the swap is now. So that means when you place a trade and you take it over the night, it's really very possible that you get some profit. I mean, let's not call it profit. Maybe you get some returns in terms of swap, or you get some deductions in terms of swap. But like I said earlier, it really doesn't really matter that much. Okay, it doesn't matter that much at all. Okay, so let's look at what we have next. Okay, so when you in the forex market now, in the forex market, what we trade here is the exchange rate, like we established last week. Let's say, for example, the pound dollar, this is the British pound, and this is the United States dollar. So the currency pair, let's say this is the exchange rate, okay, of the pound dollar, right? 1.23451. So what we do, what we trade is this exchange rate. Okay, this is the market. This is the price. This is the market you are trading, and this is its price. Its price is going to either increase or decrease every second, every minute, every hour that the market is opened. And there are different factors that will affect, okay, that will cause this exchange rate to go higher or lower within a particular time frame. And we're going to talk about those things later when we get to the analysis aspect, where you're going to learn, things that you need to consider. You're going to learn trading strategies that will give you directions of your trades, all right, and all those things. So we're still looking at the basics. So let's now look at the GBP USD, the sterling dollar, pound sterling dollar as a market. This is what we call the rate, and this is the instrument you are trading. So together you call this quote. So when you have GBP USD equals 1.234, what it means is that 1 unit of the British pound is equal to 1.23451 United States dollar. Okay, that's just what it means. Okay. All right. So that's what it means. It's just like you say USD Nigerian Naira is 415. So this is the way it's going to be quoted. So instead of you to say 1 USD equals to 415 Naira, you just write this USD NGN equals 415. Okay. So this is what we call a quote, a currency quote. Okay, so we're just still trying to define the terminologies and all that. It's just like every other profession, right? If you're a doctor, you will understand how to use the stethoscope. You know different all those big terms that they used to talk about. Okay, if you are if you're a footballer, you know what throw in, you know what is dribble, you know all those kind of stuff, right? So it's just the same thing we are doing now. Okay, it's just the same thing we are doing. Now, the difference between an old rate and a new rate is measured in pips. Now, this is a quantity. And a quantity, just like we say, can either increase or decrease. And now there is a SI unit, okay, a way of measuring the size of that change, right? Everything is moving. Nothing is really nothing is really going to stop, including the financial market. It's going to keep moving unless the market is closed. So when it's moving, it's definitely going to move from one point to the other. How do we measure how far the market has moved from one point to the other? So in the Forex market, we measure that in what we call pips. So these rates, they are moving in pips, just like when you're looking at length, you talk about inches, centimeters, meters, looking at kilometers if it's a very far distance, looking at weight, you look at kilograms and all those things. Okay, so if I weigh 65 kg and let's say the best weighs 90 kg, okay, definitely, because it will, our weight will be much more comparable. It will be comparable because they are both quoted in the same unit of measurement, right? But if you ask me and I say I weigh 50 kg, and I ask you, you say you weigh 50 centimeter. Like, I'll be like, how do we compare the two? So I won't really understand. Okay, so it's just the same thing there. The unit, the SI unit is in pips. So as the market is moving, it's moving in pips, it's moving in pips, it's moving in pips. Okay. Okay. So there are now some currency pairs that are in 5 decimal places, as you can see this one, while we have some currency pairs that are in 3 decimal places. Okay, those ones are in 3 decimal places. So a pip is the smallest price move that an exchange rate can make based on Forex market convention. Pips is measured from the 4th decimal place. So let me take us to a whiteboard. So let me take us to a whiteboard. So let's say the GBP USD exchange rate is 1.10655. This is the exchange rate, right? Now we say this thing, they move in pips. How do we now know the number of pips from one point to the other? The pips calculation, let me use another color. The pips calculation starts from here, from the 4th decimal place. So this is in units. This is in 10, just like 100 unit that they taught us in mathematics in school. I know some of us don't like mathematics. Okay, but it's not a difficult one. So this is the 100, this is in thousands, this is in tens of thousands, right? This is like 11,065 pips altogether. So this is from the unit. So let's say you are looking at price, let's say a price, this now, price now move from 0.1.0655 to 1.11. Okay, let me not go more. 10855. And I ask you, how many pips do we have in between them? Okay, how many pips do we have between this price and this price? So if I put them side by side, this is going to be 1.10655. And this is going to be 1.10855. Now, if I want to measure the pips, I'm going to cut this somehow. We're still going to talk about this. I'm going to cut this somehow and start my pip measurements from here. All right, start a pip measurement from, okay, okay, this one's supposed to be, let's say we put the bigger one at the top and we'll put the smaller one at the bottom. 85 is bigger. Okay, and I want to subtract. This is the unit. 5 minus 5 is 0, right? 8 minus 6 is 2. Every other thing is the same. So this is going to be 20 pips. So that means from 1.0655 to 1.0855, the price has moved what? 20 pips. All right. Let's look at another example. Let's say the same currency pair moved from 1.0655 to 1.2755. And I want to calculate how many pips in between. Of course, I'm just going to do 1.1065. Don't worry, I'm still going to show you simple tools that you can use. So you're not going to be doing calculation. Don't worry. I know some of you don't like calculations. Okay, so let's cut this place off because whatever we have here is not even up to 1 pip. The pip measurement start from here. So this is going to be 0, this is going to be 1, and this is going to be 2. Other ones are the same. So this is what? 210 pips. Okay, that is 210 pips. So you ask me, what about this one? Now, this one is not up to 1 pip. It is called pipette. Pipettes. Pipettes are not up to 1 pip. All right, they're not up to 1 pip. So that means I didn't mean we have okay, someone just seems like a magician on the board. Okay, let me put it very well for us. So let's say price was at, it's just simple subtraction. Okay, do we have our calculators, or if you have your calculator or phone, let's use calculator now. Okay, let's use our calculator. Okay, let's use our calculator so that it won't be like somebody said it's like we are practicing magic. Okay, says we have that's Victor says like okay, let's explain it very well to Victor so that he will understand it. So what we are trying to do is peep movement. Perhaps maybe Victor joined late. So let's say GBP USD at some point the price of GBP USD was 1.02557, for example. But later it increased, let's say it increased to 1.1099888. So we now want to measure how many pips do we have in between. We say that pips is what we use to calculate how price has moved from one point to the other, how far it has moved from one point to the other. So what we're just going to do is just going to be something very simple. It's just basic subtraction. So if you have a calculator, can you please do this for me? So let's do this together. All right. So let's know. So please, somebody should do 1.10888 minus 1.02557. Okay. Somebody should do that, please. Let's see what we have. I want somebody to do it. I don't want to be the one. Okay, let me do my own. I won't say it. I'll just do it. So as to verify. Somebody should do that for us, please. Okay. Okay. So my calculator. I've grabbed my calculator. So I'm still waiting for the response. 1.10888 minus 1.02557. Okay, I have my answer. So do we have anyone with an answer? Anyone? So I have Sam Rebecca is raising up her hands. Okay, so I have a response from somebody. Thank you. So I don't know if Sam wants to say something. Sam, if you want to say something, please type it. Let me know if you want to say something. Okay, just I don't know if you are raising out to say something. So I have Emmanuel Musa saying it says it's 1.08331. And then I have Omoda Yoshito says it is 1.006323. I have Indube say 833 pips. Okay, the correct person is Emmanuel Musa. That's 0.08331. I don't know, Omoda, maybe that was a mistake. And Indubes has already even completed the whole thing. Okay, so which is very correct, 833 people. Okay, but let's just bring it from the raw calculation, the value that we get from the calculator, which is 0.08331. All right. So like we said, that the peep counting start from here, the fourth decimal place. Okay, so that is 831. You just ignore any point zero, whatever at the front. Just ignore it. So once you do your subtraction, you have 833 here, 833. What about this one? It's not up to 1 pip, so that's going to be 0.1. That's 833.1 pips. Okay, I know. Okay, let me show you a very simple way. Instead of you disturbing yourself, this so just multiply by 10,000. So once you do your subtraction, okay, multiply by 10,000. So try it on your calculator and see. So you see that you're going to get 833.1. Okay, 833.1. So pips. So that is the number of pips that we have between these two price points. Okay, GBP US dollar moved from 1.02557 to 1.0888. So that means it has increased by 833.1 pips. And that's how you do the calculation. You subtract one from the other and then multiply by 10,000. Okay, multiply by 10,000. All right. So that's how it looks. And that's how it works. That's how we do all those calculations. So let me take you to our trading platform quickly so that we'll see what I'm talking about. So as we are saying it, we'll check it there. All right. So I will now ask us, I will now give us a little bit of exercise so that we just nail it in. Now, this is what I am saying. This is what we call the market watch. So we're going to look at this trading platform on Wednesday. Don't miss this class. It's on Wednesday. We're going to demystify this trading platform. You're going to learn everything you need to know about the trading platform. So you can see the other times, these are the instruments you can trade on the Greenwave Exchange platform, ranging from the currency pairs to the stock market, UK stock market, US stock market, stock indices, commodities like gold, oil, crude, cryptocurrencies, so many instruments you can trade. But if you look at the currency, like this is Euro USD, this is the bid price, like we said, and this is the difference between them, which is spread. So this 1.5 pip. So you would notice something that there are some currency pairs that are in 5 decimal places. Also, there are some currency pairs that are in 3 decimal places. All those currency pairs that end with Japanese yen, because many decades ago, some decades ago, the Bank of Japan devaluated their currency. So it makes it to really be very, very minute. So when you convert the yen to some other currency, it's going to be really very big. So instead of them to be in 5 decimal places, they're in 3 decimal places. Example is this GBP JPY. That's the pound sterling Japanese, and you can see it's in 3 decimal places. This is New Zealand Japanese yen. It's in 3 decimal places as well. There's so many other examples. Any currency pairs that end with Japanese yen is going to be in 3 decimal places. This is Singaporean Japanese yen. This is 3. You can see 3. This is another one, another currency. This is an exotic currency pair, right? This is an exotic currency pair because TRY is not a major currency. That's the Turkish lira. Okay, it's not a major currency. So for you to know the name, just put your cursor on. You see the Turkish lira versus Japanese yen. So it's in 3 decimal places, the exotic currency pair. So they are in 3 decimal places. So for those currencies that are in 3 decimal places, how do you calculate the number of pips between them? Okay, how do you do that? Let's quickly go inside. Okay, now those ones that are in 3 decimal places, when you want to know the number of pips that are between one price point and the other, all you need to do is to first subtract the first price point from the second price point. Instead of you to multiply by 10,000, you multiply by 100. It's as simple as that. But those ones in 5 decimal places, you multiply by what? 10,000. I'm going to give us some exercises, but let me give us an example, a Japanese examples first before I give us some exercises. So let's say you have the dollar Japanese yen currency pair. That's the USD JPY currency pair. And of course, we know that this is the base currency, the USD, and Japanese yen is the currency counter currency. Let's say at some point the rate was, the first price point was, let's say 102.775 in 3 decimal places. Okay, that's the first price point. Let's say PP1, price point 1. Okay, so let's look at price point 2. Okay, let's say price point 2 was smaller than price point 1. That means price dropped. As you know, currency pair could either the exchange you could either go higher or drop, and you can actually trade whichever direction the price moves. Excuse me. So let's say the US dollar Japanese yen drop from this price point to, let's say, 101.393. So how do we now calculate the number of pips in between this? All you need to do is to do price point 1 minus price point 2. Very simple. And whatever you get, you multiply by what? Multiply by 100. Okay, very simple. So if I do, let me quickly do that because I'm still going to give us some exercises that we can quickly look at. 102.775 minus 101.393. So you have 1.382. 1.382, then I will now multiply by what? 100. So that would give me what? 1 38.2 pips. So with that, I've calculated the number of pips between these two price points. Now, what we are doing is going to be very important when we want to calculate the profit and the risk involved in a trade. What we are trying to do here will be very, very useful. Okay, so please pay attention. If you have attended a class like this before, don't worry. There's no knowledge that is lost. Stay in and be part of it with us. Okay. So do we all understand this? So let me now give us examples. So we're going to look at two currency pairs. I'm going to give you just two exercises, and I want the fastest person. So we are going to have like 15 seconds to do it because we don't have so much time. So the first exercise is Euro USD, okay, increases. Oh, Euro USD, let's say increased from 1.22799 to 1.30095. Okay, so what is the pip difference? So how many pips difference? How do you spell difference again? Okay. Well, okay, I think this. How many pip? What's the pip difference? So what's the number? How many pips do we have in between those two price points? So I want somebody to do that. And then the second one, quickly, is gonna be let's say the card Japanese yen. The card Japanese yen dropped from 98.662 to 98.611. So the same question, what is the pip difference? Okay, between the two price points. Okay, so those are the questions, and I want answers quickly. So we have just 10 seconds. I will start counting. Once it's 10 seconds, then if we don't have any answer, then I will have to just answer so that we'll go quickly. But I'm trusting, I'm open on you guys. I believe it's very easy. It's something we can easily deal with. So let's do this quickly. So I have the first answer, Euro USD answer from Omodayo Shitu. It says 0.07329 answer for the first. No, that's wrong. You have to convert to pips. Okay, you have to convert to pips. This one is just different between the price, but you need to give us the pips. Okay, so please do it properly. I have a DME says for the first one, it's the euro 7.329. Is that the number of pips? Okay, please put it there that 7.329 pips. Okay. We have to start getting used to it. Okay, 7 point something pips, this. So let's put those things there properly. I have Emmanuel Musa says 732.9 pips for the first one. And I have Victor gave us the two answers. That's impressive. The first one he said 732.9 pips, and the second one he says 5.1 pips. Thank you very much. We have Adeyemi or Shinobi who says 7.329 pips. Maybe I think you are talking about the first one, 7.329 pips. Okay, thank you for the answer. And Omoda Oshitu says 732.9 pips for the first one and 5.1 pips for the second one. So that's the same answer with Victor. Okay. So I think that's all. Thank you very much for those of you who participated. I appreciate. So let's check the answer now. So I think the first answer is 732.9. Okay, I've not done the calculation actually. Let me do the calculation. Okay, but I was trying to do majority because we have a lot of people who say, but let me verify minus. It's just to subtract. Okay, the first one you subtract one from the other and then multiply by what? 10,000 because it's in 5 decimal places. Okay, 5 decimal. So the answer is 732.9 pips. Okay, that's 732.9 pips. So who are the people that are correct? We have Omodayo, we have Indubest, we have Victor, we have Emmanuel. Okay, those are the people that are correct. So clap for yourself. You did very fantastic. Good job. And the second one, that one is a Japanese yen currency pair. So understanding basic things like this is what will help you to build a solid knowledge foundation for yourself as a trader. You will not, you won't believe me if I say that we have traders who say they are trading and still understand they don't understand those things. That can be really very disastrous. So let me look at the second one. 98.662 minus 98.611. That's 0.051. Then I'm going to multiply by 100 because it's Japanese yen. So that's 5.1. So fantastic for card Japanese yen. So I have Emmanuel Musa Ndu Best, Adeyemi or Shinobi. I have Omodayo Shitu. I have Victor. Fantastic, fantastic. Thank you very much. So perfect. So we are done with pips, right? When we get to the market MetaTrader 4, that's the trading platform we're going to be using to trade, the software we'll be using to trade. You're going to also learn a tool that you don't even need to do calculation. It's just to use that tool to measure. Just the tool is just like a ruler, and then you just use it on your charts, and then you know the number of people. But it's still really very good that at least you understand how these things are being calculated. Okay, fantastic. So go back to the slide and look at what we have next there. Okay, so let's now look at lot size. Let's look at lot size quickly. Now, lot size is just like it's called size. When you want to trade in the Forex market, you need to understand how the quantity of transaction is being sized, is being measured, right? Just like when you go to let's say, I like using this example a lot, the rice market. Okay, who can tell us, the biggest size, like the standard, when it comes to the rice market, rice? Who can tell us what is the standard size? Quickly, what's the standard size? The standard, it is from from this particular measurement of rice that other ones are really being taken from, because it's not everybody that can afford that quantity of rice, right? So everybody they will have to, and then traders needed to just devise method of breaking this thing down so that a lot of people can get the quantity that they want. So Indubest, thank you. Indubest say bag. Victor says a bag, 50 kg. Fantastic. It's the 50 kg bag. That's a 50 kg bag. So if you want to buy multiples, you buy in bags, right? But if you want to buy fraction of that, we now have half bag, 25 kg bag, right? We even have 10 kg. In fact, I saw 5 kg which day. And now we have in rubber, yellow rubber, right? We have half of that yellow rubber up to the Rika, up to that smaller thing. Everything is taken from the bag of rice. Okay, everything is taken from, and the bag of rice, the measurement is 50 kg. It is from there. That is the standard. All right, that is the standard. So it's now the merchants, the trader that started breaking it down for people. So this is a perfect example of what we do in the Forex market as well. So the 50 kg bag that you have there is in the Forex market. We have something something related to that. We call it one lot. And just like 50 kg, yeah, just like one bag is 50 kg, one lot is 100,000 units. No, this one is a number. The rice is in kilogram, right? So this one is 100,000 units. So a lot of euro US dollar means 100,000 units. And just like we have in the rice market also, you can buy multiples of this: 2 lots, 3 lots, 4 lots, 5 lots, 10 lots, 20 lots, and so on. You can also get fraction of this, fractions in one decimal place, like 0.5 lot, 0.2, 0.1, 0.3, 0.4, 0 up to 0.9, even up to 0.99. And even having two decimal places, you have 0.01, 0.02, 0.03. It's just been broken down so that everybody can participate in the market. Everybody. Because if you look at it, if you want to buy, if they had said that, okay, the minimum you can trade is one lot size, if they had actually said that, what that means is that if you want to buy euro US dollar and the value, or let's say the exchange rate of the euro US dollar is, for example, 1.22450, and you now want to buy, let's say the minimum is one lot size. So that means you need to buy, since one lot is 100,000 units. So that means you have to do multiply 100,000 units by 1.2245. All right. So because 1 unit of euro US dollar is this. So 100,000 units is going to be this. Do you understand that? So if you multiply that, it just is basic calculation. Just like you buy, let's say euro US dollar is one orange. Then I say one orange is this is the price of one orange. And you now want to buy 100,000 of oranges. What will you do? You multiply, right? So really basic arithmetic. All right. 100,000 times 1.2245. So that means the price now is going to be what? 122,450. If they now say this is the minimum, now tell me, how many people will be able to trade the Forex market? How many? If you are one of them, let me know. They say that if you want to trade, this is the minimum you can trade. The minimum. How many of you will be able to afford that? How many? Not many people, definitely. This was how it used to be, many years back, until we have the dealers, the brokers. They now break all these things down. They now started offering in micro lots, in mini lots, okay, in smaller sizes. So that just like the way we have the rice sellers now offering it in tin, in Derica, and all those things. It's just the same thing. Like I told you guys before, that this is just like every other market. The only thing is that the instruments are different, okay, just like the way every other market works. So nothing really spectacular, nothing difficult about it, okay. So they now say, let's now say somebody else, let's say you cannot do one lot, and let's say you can only do 0.1 lot. 0.1 lot is what? It's 10,000, right? It's 10,000 units, right? It's 10,000 units. So it's just like 10,000 multiplied by 1.2245. What happens? It becomes what? 12,000 245 dollars. Okay, even you can even do 0.01 lots, which is going to be like 1,000 units. Then multiply by 1.2245. So you're going to have 1,2245. Meanwhile, okay, the minimum lot size you can trade, buy or sell, is 0.01, which means that there is still one more problem. The problem is that even with all the breaking down by the brokers, with all the breaking down, the minimum transaction anyone can still do is this. And how many people can afford that again? Not many, not everybody. All right. But we want to really break it down so that everybody can be part of it. So that's why when they say the minimum deposit is $50 and all that, this is why they talk about it. The next thing I want to talk about. Okay. Now, all these things we are doing are just nominal value of the transaction itself. So that's the normal value of these transactions. That is the normal value, okay, of these transactions. Okay, are we following? So if you want to buy one lot size, that's 100,000 units multiplied by the price of what you want to buy or sell. That's the normal value. If you want to do 0.01 lot, that's 1,000. That's like 0.01 times 100,000. That's 1,000 units multiplied by the price. That's what you have. That is the nominal value. That's what you need to deposit, what you need to pay before you get involved in that kind of transaction. Okay. And this is what we call margin. All right. We call them what? Margin. You know, every profession has its own terms. Okay, Victor is asking, I have a question. One person can make multiple trades at a time. Yes, you can make multiple trades at a time. You can have 2 trades running, 3 trades running. So if they now say this is the minimum, how will you be able to, you know, so you say if the person trade with 1,100 so that means if this is going to be the minimum, that means your account has to be like your normal money that you want to use to trade needs to be like $1 million or $100,000, all right, or $20,000 because this one is just on a trade. Okay. So Victor is now asking, how does a $50 person make a profit? How it's not even about make a profit. How does he even have a chance to trade? How does he participate? Right. And that's what we're going to now. That's something I'm going to explain to you that even breaks this down, break it down so much. And that's what make the Forex market very, very lucrative. All right. But what we need to take home from here is this is how we can simply calculate the nominal value of a trading transaction. This is how the market understand the value of those transactions. Okay. And these are like, okay, let's just call it the nominal value. These are the nominal value, the normal value of those transactions. Okay, so what now makes it, just like what Victor asked, what now makes it easy or possible for $50 guys, in fact, $20 guys, in fact, $5 guys, okay, to get involved? All right, when we know that this is the minimum ever in terms of transaction value that anyone who wants to get involved in the market can do. You can't do less than 0.01 lot. They've tried, broken it from 1 lot to 0.01. All right. Now, there is a concept that is now being introduced. That concept is called leverage. Now, every rich person in the world became rich, or they are all becoming richer because of what we call leverage. Now, leverage is when you make money on borrowed money. When you hear that people like Dangotes and all those big business people, Tony Elumelu, Otedola, Jimovia, all these big guys. When you hear that they go to the bank to borrow money, do you actually think that they cannot finance those projects on their own? Do you think so? When you hear that Dangote is trying to borrow 200 billion naira, for example, from a bank, and you hear, according to Forbes, that the man is worth maybe 12 or 15 billion dollars, and $1 billion is already enough. So why? The reason is that leverage. The reason is what we called leverage. So let me just give us an instance, an example that I like citing. So let's say there is a particular business. And for example, I know there is nothing like this, but let's say there is a particular business and it is sure that at the end of the year, you're going to make 100% return from that business. Let's assume that it is very, very certain. You are very sure. You understand the business in and out. You've done all your assignments. You've completed all the papers. You have made all the contacts. You have done every necessary things, and you're clear. You know that for sure. If you invest some money into this endeavor, you're going to make 100% return. So we now have two guys, two friends. Let's call the first one A and the second one B. All right. So each of them, let's say they are brothers, brother A and brother B, they are brother from the same father and mother, and they got to know about the business and they want to do, each of them want to invest his money in there. And let's say their father gave them 100,000 naira. Okay, and definitely, if you know that it's very certain that you make 100% from some, you want to put the all of your money in there, right? So this person want to put 100,000 in there. Now, let me ask you first, if you know that there is a business, let me ask you guys first. Let me ask you, if you know that there is a business that you can do, and you know certainly that you're going to get 100%. In fact, they told you if you don't get 100%, you definitely get 100%. You know, let's just say there's something like that. All right. I know there is no certainty anywhere, 100% certainty. Let's say there is something like 100%. So if you have 100,000 naira, what will you do? Let me ask you guys. Let's answer fast so that we can quickly conclude on this. What are you going to do if you have 100,000 naira? What are you going to do currently? What do you think is the smart thing to do for you? Is it that you will invest the whole of your money, you will invest part of it? Just exactly what are you going to do? Okay, I have Victor says, I will go ahead, borrow more money to invest. Okay. Let me get a response from like two more people. So Victor is going to go ahead and borrow money. You want to borrow money? Okay, so let me get a response from the others. Maybe like two more persons. Two more persons. Let me get. Okay, I have from Adeyemi says, I will invest 100K without borrowing. All right, good. That's what Adeyemi is going to do. Let me get from one more. Okay, from Omo Dayo, Shitu says, I will invest my money first, but not all. I will divide it and have the rest as backup. This is what I'm saying. No, I'm saying this one is certain. You don't get. I mean, there's no risk. Assuming it's just an assumption. There's a clause that assuming there is no risk involved. It's certain. Let's say it's a government bond. Government bonds are of very high certainty. Let's say you borrow the United States government money in the bond market, and they say that the value of this bond is 100%. I mean, the ROI on this bond is 100% at the end of the year. So what will you do? You have 100,000. What are you going to do? Yes, Sheya Adekola have answered that. Yeah, positive, 100% guaranteed. There's the word guaranteed there. Omodayo then says, I will invest all. In the best case, I will invest all first. Okay, then what? What come next? There's still a sign of doubt there. I will invest all first. And then what? So I have Sheya Adekola, I will borrow more and invest. Okay, thank you very much. Good responses. Okay, so let me just, I've noted all your answers, but let's go forward. Let's look at these two scenarios. So this is what this guy did. He invested all of his money, like some of you said he would do. And then at the end of the year, he gets 100,000 naira back. And at the end, all his money is 200,000 naira. And he makes what? 100,000 naira. So ROI of what? 100%. Now, that is a very nice business. But let's say the other guy is the one that takes, risk. Let's say just like, if this thing is really very sure, why not just borrow some money? Okay. So let's now say it goes to the bank that I want to borrow 1 million. And the bank says you have to give us a collateral that worth 10%. Or you just tell them, or you just go to the bank and say, I want to borrow 1 million naira. I have 100,000. So can I drop this 100,000 naira while you monitor the business? You're going to monitor the business. And once you discover that I'm going to lose this 1 million naira, you close the transaction. I don't know if you guys understand. You give them a kind of clause like, okay, I have 100,000. I take this 100,000 naira. This is 1 million naira. Give me 1 million naira. Make sure that I don't lose more than, you already have 100,000. Make sure I don't lose more than 900,000. Once you discover that I'm losing 900, make sure I don't lose more than 100,000. But just give me this 1 million naira. Let me use it to do business. But monitor it. But make sure. But the bank is now saying, we'll make sure that once the value of your investment is getting to 900,000, we're going to close it and collect our 900,000 back and add to this 100,000, and then you've lost the 100,000 naira, and then that's it. I don't know if you guys understand. If you understand this, the picture I'm trying to paint, let me know. While you respond, let me take it again. So this guy goes to the bank 1 million naira to borrow 1 million naira, and he's saying, I will drop this 100,000 naira. Give me 1 million. Meanwhile, we are going to enter into a kind of contract that I am not going to lose up to 900,000 naira. Okay? I'm not going to lose up to 900,000 naira. So they will be monitoring the investment. The maximum I can lose on that investment is 100,000 naira. The maximum I can lose is, once the investment is getting to 901,000, 900,000 and whatever, they will just close it. And then, since they have 100,000 already, with their 900,000, they keep it to themselves. Meanwhile, if I make profit on this thing, I'm going to give you 5%. You're telling the bank that's a good deal for the bank. That's a good deal because the bank knows that they are not into any risk. And when you make money, they can still make 5% from your profit, but they're not getting engaged in any risk. They will give it to you. Okay? With all those clauses, they will give it to you. Okay? So you get 1 million naira from them. Your 100,000 naira is with them. Okay? Your 100,000 naira is with them. They give you 1 million naira. And what they're saying is that, see, you can make whatever you want. If you like, make 1 billion from this 1 million. We don't care. Just make sure we get our own 5% of the profit you make. And just make sure the maximum you can lose is still your money on top. They're only just giving you that money in case you make profit. They're not giving you that money to lose it. They're giving you that money to make profit with it. So now you that know that, okay, you're going to make money, definitely, you just take it. All right. So let's say at the end, you now make an extra 1 million. And that's 2 million naira, right? You are going to give the bank how much? It's 900,000. Okay. Or let's say you're going to give the bank back their 1 million. That's the first, but they will give you back your 100,000. So let's say at the net is going to be 900K that the bank is going to remove. When they give you your 100,000, I give them back their 1 million. And also, you're also going to give them 5% of this 1 million, which is going to be what, 50,000. So at the end, you're going to give them 950K. All right. So when you now, how much are you going to have left? You're going to have 1,050,000 naira left. You're going to have 1,050,000 naira left. That's going to be your profit. Do you get that? So the 100,000, you've completed everything. Okay, all the transaction, all the deal with the bank, you've already completed it. Okay, the deal is done. So, but you make 1,050,000 naira. Now, this is what you now compare what this guy makes and what this guy makes. They both invested how much? 100,000 naira. But this one invested directly, while this one invested indirectly. Now, the Mr. B make use of what we call leverage. This is just what we call leverage. Okay, this is just what we call leverage, while this one is profit without leverage. And that is what makes the Forex market very lucrative, because you can trade on leverage. Okay, so different brokers have different leverage that they offer their clients. On Greenwave Exchange trading platform, you can get up to 1 to 500 leverage. You're going to see the impact of the leverage now here. So Great Wave Exchange can give you up to 1 to 500 as leverage. So what impact does this 1 to 500 have here? Let's look at them one after the other. Now, if you're giving 1 to 500 leverage and you want to trade a transaction that is this big, instead of you to pay this, the broker is going to divide this by 500. Okay. This is going to be divided by 500. So that means you're not going to pay $122,000 anymore, divided by 500. So that means this is now going to be $244.5. This one is what? $24.45. Why this one is what? 2.445. So can you now see why somebody that has $50 can trade leverage? If you get that, just type 1. If you get that, if it makes sense to you, if you appreciate that, just type 1. I want to see your 1. If you don't type 2. If it doesn't make sense to you, type 2. If it makes sense to you, type 1. I want to see your responses. Let's make it sharp. Let's make it fast. So you see that. That is why the person that asked that question, that is how you can trade all these big transactions with this small money. And meanwhile, mind you, let's say this is the transaction you take. Although this is the money you are depositing, just like you have to deposit money to that bank, this is still the real value of your transaction that the market understands. This is like your 1 million borrowed from the bank, right? And you are going to, whatever profit you make on this, just like that guy that borrowed 1 million is going to keep that profit himself. Meanwhile, this is just what is dropping, just like that 100,000 that is dropping. That's why it is really very possible to make multiples of what you are risking. So that means on this trade now, someone can even make $10 on it. Meanwhile, this is how much you drop. So let me read your responses. So I'm seeing a lot of 1 here. Okay, so I have Omo that says, but your profit will be along your trading. Yes, your profit is not going to be based on this. It's going to be based on this. Okay, so I have Victor says it types to that means it doesn't make sense to him. Is leverage borrowing 1 million better than 200K? Because I could see profit of 50K. No, we're not talking about profit now. Okay. Are you talking about the instance that I gave? Please let me understand better, Victor. Are you talking about the instance that I gave? Is leverage of borrowing 1 million better than 200K? Because I could see profit of 50K. No, that's not a profit of 50K. So the guy made 1,050,000 naira. All right, that's what he made, and his total investment is 100,000 naira by making use of borrowed money. See, that's how the rich people do. Instead of them to put their money, they may have the money, but they will borrow it. Give the bank, let's say the bank is saying, okay, we're going to charge 20 something percent interest rate of 15% or 12%. They know that they're going to make much more than that. They pay the bank off. They are using the bank's money. And what is the bank's money? People like you who deposited their money in the bank. All those smart, big rich people. They use your money to make more money for themselves. That's how the world of finance work. That's how everything works. Okay. Yes, it will return the 1 million naira to the bank. It's not returning 1 million naira to the bank. Okay, let's say okay. This is what happened. He invested 1 million. He makes 1 million. Right? At the end, he has 2 million. So if he returns 1 million naira to the bank, how much does he have left? He makes a profit of 1 million naira. Okay. He returns 1 million naira to the bank. How much does he have left? 1 million. Abi, the bank is going to give him back his 100K, right? So that's 1.1 million. And at the end, it's going to give the bank 5% of what he makes as profit, which is 5% of 1 million. So if you remove 50,000 from 1.1 million, gives you this. I hope you understand that. Okay, he has made 2 million, he didn't make 1 million. This 1 million invest, he made 1 million, but he didn't lose the bank's money. This is the investment, this is the profit. You add it together, you have 2 million at the end. You pay the bank their 1 million that you borrow, they give you your own 100,000 naira that you deposited, and then you also pay them 5% of the profit, or even if it is 10% of the profit. Deal is done. Do you get it now, Victor? Do you get it now? So that's just how you make use of a leverage in the forex market. So your broker can give you the leverage, okay, to get involved in a very big transaction with really, really very small amount of money. Okay, now let's do let's name all this. So when you want to open a transaction with a leverage, okay, let's say you want to do 0.05 lot of euro US dollar. And at that time, euro US dollar is 1.1500. Normally, the real value is supposed to be 0.05 times 100,000. You convert it to unit. That's the way the market is going to do it. Then multiply by 1.1500. So this is the nominal value. Your broker will now give you the leverage. If your leverage is 500, for example, they'll now divide it by 500. So that's now going to be, if you do the calculation, that's going to be 0.05 times 100,000 times 1.1500. So that means, and then divided by 500. So that means $11.5. Now, what the broker is now going to do is they are going to seize this 11.5. They're going to hold it. They will hold it and release to you the nominal value, which is 5,750, just like the scenario of the guy going to the bank to borrow money. So the broker is saying, okay, we will allow you to take a transaction that worth 5,750. We will allow you to also deposit 11.5 because you are choosing 1 to 500 leverage. So we're giving you the rest of your money. You understand? We're borrowing you. Meanwhile, you cannot lose more than this 11.5. That's what it means. The maximum you can lose, so that when you lose that 11.5, they cut it, and then you'll never get this one back. All right. But if you make money on this, okay, let's say you make 0.1%. All right. Or let's even say we make 1% on this. That's going to be $57.5. It's going to be your own. All right. That's just going to be your own. And then the broker is also going to release this fund back to you. But if you lose, the maximum you can lose from it is just 11.5. All right. Now, this value, this is what we call margin. Margin is that money you need to deposit, okay, to get the value of a transaction, okay, to take a transaction. That is what we call the margin. Okay, that's what we call the margin. So you need to always understand the margin. All right. So as you are taking trades, you are making use of margin. As you are taking trades, you are making use of margin. As you are taking trades, you are making use of margin. So let's say, for example, after this, we're going to now look at how to calculate, profit and loss. Okay. Now, let's say, for example, you deposit $200. Okay. Let's say 500. And you open 0.02 lots of GBP US dollar, of GBP And the current exchange rate of GBP US dollar is what? Let's say 1.1150. And you chose a leverage of 1 to 500. The first thing the broker is going to do is to calculate the margin based on what you choose. You're the one that will choose what lot size you want to use. You're the one that will choose the leverage. If you have chosen this at the beginning, lot size, they will just do the calculation for you. Do your 0.02 multiply by 10,000. That one is just to calculate the number of units. This one is converting the lot to units. Then multiply by the value of 1 unit. Then divided by 500. So you'll see what's going to be next. Now let's just continue. We're going to check all these things on the MetaTrader 4 in the next class. All right. So divided by 500, the normal value is $2,230. But with the leverage, you are just going to drop $4.46. So what the broker is now going to do is that, okay, they will say, this is your margin. If you want to take charge of this trade, this is going to be the margin. So that means your account balance must be bigger than this. So you as an investor, it makes sense as a trader because you have 500 and you're only taking they're only seizing about $4.46 of your money. So this is going to be your balance. Your balance is still going to be $500. But the margin that you have used, is how much? $4.46. So that when you now want to take another trade, let's say this trade is still ongoing and it's still holding in this margin. When you want to take another trade, the broker is not going to look at your balance because literally they are seizing $4.46 from your account until this transaction is done. All right. So they now have what we call margin, or let's say free margin. So that means your free margin is not going to be your $500, which is your balance, minus your 4.46, which is the margin that you have used. So that means the margin that you have free is now going to be 500 minus 4.46. That's going to be 495.5 approximately. So that now means that next time you want to place a trade, the broker is going to look at this. It's going to consider your free margin instead of this. So that means if you try to open a trade that the margin required is, let's say, 496, the trade is not going to go through. Why? Because you don't have enough margin. You will say, okay, I have balance. I have people who are already trading who ask this funny question. But I have enough balance now. But why not check your free margin? Every time you have a trade going on that you have not closed, your broker is going to hold down a margin. That's like a deposit. Just like that example. It's just like that guy now going to the bank to collect his 100,000. They will say, no, they can't give you until the whole transaction is what? It's done. It's business, right? The broker wants to make money. They also want to protect themselves. That's how it works. Okay. So you have 495.5 as the free margin. So when you want to take the next trade, it's a free margin that will be considered. So that means you're not going to open a trade that is bigger than the margin that you have that is free. Okay. Do you guys understand what I'm talking about? If you understand what I'm talking about, just type 1. Let me know if you understand what I'm talking about. Type 1, 1, 1. Don't worry. We are building a foundation, and as time goes on, you're going to get this very, very well. And as you start practicing, when you start trading, you appreciate, well, the way I'm breaking it down for you, you appreciate it very, 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 very well. Okay, that's why you should not miss any of our classes. Okay, please attend all of our classes. So that's it. So if you open another trade, the one you have here is your free margin now is, let's just say, $495. If you open another trade, the broker is going to calculate the margin required on that trade also. So if, let's say, the margin required on this particular trade, on the new trade that you take, based on the calculation we've known how to do, is $10. So that means your free margin now is now how much? Who can tell us what the free margin now is? So what is the free margin now? So you take the second trade. This is the free margin before you take that trade. After you take that trade, what is going to be the free margin? Okay. Okay, Victor is saying, I thought there's a fixed price to be given to you, just like you're borrowing from the bank. I'm using the explanation you gave. No, there's no fixed money. All right. It's just follow the way we are doing it gradually. Okay. Emmanuel Musa say 485. Perfect. Indubes say 485. Modayo Shito says 485. Yeah, that's gonna be 485. That's gonna be your free margin. You have two trades ongoing. Now let's say and your balance is still going to be how much? 500. It's not going to change. So you have the first trade. The first trade is the first trade that you have, the margin there is what? 4.46. 4.46 margin for the first trade. The second trade, you have $10 as your margin. So let's now say that okay, let's say this. Let me write it very well for us. I want to give us an exercise, so just to know those that are following me. So margin one, let's call it margin one. Margin one means the margin on the first trade is 4.46. Margin two is what? $10. Right? So we now say, we know that now the free margin now, why those two trades are ongoing, is what? Let's just say 485. Of course, it's not going to be exactly that because we rounded up, but let me get the proper value. Minus 10. So that's going to be 485.54. All right. So this is going to be the free margin currently with the trades we are holding. Now, let's now look at something. So let's say the guy now closed this trade in profit. Let's say after closing this trade, he made $10. He makes $10 after closing this trade, while this one is still running. Now, the question is this: what is going to be his balance now? And what is going to be his free margin? This is a good question. So this will help me to know those that are following me very well. So this is the first margin, the margin on the first to the margin on the second trade, and this is the free margin while still holding this trade. But now, this trade, he has closed this trade in profit, $10. So what will now be is new, because once he does that, things will change. The balance will change, the free margin will change. So what will be his new free margin and what will be his new balance? All right. So anyone just drop it. The Andubes says the balance is $510. Fantastic. That's correct. And Victor, it says $491 is going to be the balance. Okay. So what's going to be the balance? What is going to be the free margin? Okay. When you make profit, your profit is going to be added to your balance. If it is a loss, it's going to be subtracted from your balance as well. But just know that at the end of the trade, the margin is going to be freed, whether it's profit, whether it's loss. Okay. The margin is going to be what? It's going to be freed to you. Okay. The margin is going to be freed. Okay. So what is going to be the balance and what is going to be the free margin? So Victor is saying the free margin. Okay, didn't answer it. Just say 510 balance. Okay, 510 is going to be the balance because it made a profit of 500. So added, made a profit of $10, added to the 500, which is the initial balance. So he has 510 naira as his balance, dollars rather. So what will now be the free margin? Remember, this was the free margin before, right? Now, when you make profit now, the thing is, when you make profit, the profit has now, it's going to be increasing your margin level. Okay, you know your margin is the function of your balance. Right? The free margin that you have is as a result of your balance minus the margin that you are currently trading. So that means if this guy makes $10, his balance is going to be $510. So just subtract his balance, his current running margin from his balance, right? This is the balance now. He has made $10 extra. So what is the margin? What is the current margin is running? This. Minus $10. So what does he have as free margin? $500. Simple. So free margin is balance minus the total margin of all the trades you are currently holding. Simple. Okay. Balance minus what? All the, I mean, all the margin you are currently using. If it is 5 trades, the market is going to calculate all of them. If it is just one, it's going to calculate all of them. So this one is not going to be deducted anymore. All right. Or another way you could do it is, if you don't want to use the margin, want to calculate the free margin now. This is your free margin. Why this trade is going on. Now, if this trade is closed and you make $10 in profit, what happened is this margin is going to be released. So it's going to be 485.54 plus this margin, $4.46. And then plus your what? Plus the $10 profit that you've just made. All right. And that's going to give you what? $500. But this is just like a long thing. All you need to do is just to do, okay, balance minus all the used margin, all the margin that you are currently using. All right. Is this simple? Should I give us another one for us to check? Okay, let me give us another one. Now, let's say after making this profit, let's say after making this profit, his balance is 510. But this trade is still currently ongoing and is still holding on this margin. So it still has margin. Margin one has $10. Let's say it now opens another trade, 2 trades actually. Margin two, that one is another $10. And margin three, he opens another trade, that's another $10. He has a margin ongoing. He has new margin and another margin, 2 trades extra. So he has 3 trades ongoing now. So what would be his free margin now? Okay, I gave a simple number so that I'll be able to do the subtraction, do the calculation simple. So what would be his free margin now? This is the balance. Now, this trade is still currently ongoing. Remember, he has closed this one. So the transaction is done here, is concluded. It makes profit. The transaction is concluded here. So, but it still has a margin ongoing here. So, but now he's now adding 2 extra margins. It's adding 2 extra margins, $10 margin, $10 margin. So what is going to be his free margin now? I have Omadayo says 480, Indube says 480. Only 2 people. What about others? Please, let's try to participate. So that's absolutely correct. So that's going to be the balance. It's still the same formula. The balance minus the total used margin, which is going to be combined $30 here. And at the end, you have $480. Okay. So the last test now, let's now say at the end, it closed two trades. It closed this one in, let's say, minus $10 loss. And it closed this one in, let's say, $15 profit, for example. And it still has this one ongoing. What will be his free margin now? So this is the balance now. He has this three trades ongoing. Okay. He has this three trades ongoing. Initially, before he closed this one, the margin was $480. But now he has closed this trade. He has closed this trade. This one in the loss of $10. This one in the profit of $15. But this one is not yet closed. It's still holding on this margin. So what will now be is free margin now. What will be his free margin? I want everybody to, I want to see like at least four answers. I'm not talking of balance. I'm talking of free margin. Okay, should we include the balance? Okay, I think we should talk about, okay, let's talk about balance too. Sorry. Yeah, that's true. What will be the balance? What will be the free margin? What will be the balance? So Ndube said the free margin, the balance is 515. That's correct because was the initial balance. Now he lost $10. I made $15. That's a net of $5, right? $5 profit net. If you add it here, that's 515. Absolutely correct. Good job. As I have Victor says 485 is the free margin, right? Omoda Shito says 495 is the free margin in the best. I don't know. I don't know how many people have answered that. Free margin, she says 485 is the free margin. But I know Victor says 485 too. Omoda says 495. Okay, let's check. So now that he has closed these trades, his balance is going to be 515. But it still has this margin holding. Remember, how do you calculate free margin? It's going to be your balance minus the currently used margin. And now the currently used margin here is $10. And that's going to be what? Okay, that's going to be what? 505. It's just use the formula. Free margin is balance minus used margin. New balance is going to be old balance plus profit or old balance minus loss. Simple, right? Very straightforward. Okay. Okay, so you guys have done very well. Fantastic. Don't worry, you're going to get better at this. It's really very simple. Very simple. So that's how margin and leverage are really being calculated, and that's how important they are. Okay, so we're going to quickly look at two concepts, and then we'll now learn how to calculate profit. Our time is fast spent, but we really need to complete this. We need to complete it. Okay, so now that is what we call margin level. That is what we call margin call. And that's what we call stop out. So when you are trading and making use of your margin, if you are not really very careful, if you are taking too many trades and you are risking so much, and maybe market is not going in your favor at that time, you definitely going to be using up your margin, right? You'll be exhausting your margin. If your balance was $500, even if you don't close those trades, let's say you open one trade is 75 loss, another one is $150 loss, another one is maybe $200, just another one is $50, and cumulatively this 425. What happens to your margin level? Your margin level is in red. Okay. This is only for people who are very aggressive and who don't really know how to trade. Okay, well, we're going to make sure that you don't get into all this. So we know we're just explaining some concept, definitions. So that's going to be what we call, your margin level is red, like red. And once your margin level is entering red like that, you're going to get a warning, especially if you have those trades still opened. Those trades are still open, they're in losses, and then margin is what is being held. And meanwhile, remember, you cannot lose more than you cannot lose more than your balance. Your balance is the total margin that you have. Is the total margin that you have. So you're never going to lose more than your balance. Remember that. Although the broker is giving you a lot of money to trade with, giving you leverage to support your money, okay, giving you like multiples of what you have to trade, but you're never going to lose more than that. Just like the example that we gave, that guy is never going to lose more than that 100K. So once they discover that you are now losing close to your balance, your margin, the total margin that you have that has been held, okay, is really, really close to what you have here as your balance. Your margin level is dropping so much, you're going to be given a warning. That's what we call margin call. So when you enter margin call, it means that you are exhausting your margin. Your margin level is in red. Such a person is maybe is very aggressive, because in the forex market it's very easy. It's possible to triple you can fund $500 and make $1,500 in one day. You can fund $500 and make $5,000 from it in one day. But to achieve that, one has to be very, very aggressive. And so that's for people like that. Okay. And you're going to be given a warning that your margin level is so low. It's just like when you're driving and the fuel level is so low, you're going to get a green light that your fuel tank is really, really below the level it's supposed to be. It's not that it's no more there. It's not that you don't have no more fuel. Okay, just a warning that the level of the fuel you have in your tank is at the warning level, so that you can just go to the next filling station and refill your car. So it's the same thing here. So you're going to be given a warning, which is called margin call by your broker, so that just to alert you, to let you know that, okay, this is what you are doing. I hope you know what you are doing. Okay. So that you can now maybe fund more money or close those trades. But if you continue to hold it and things really get bad and it's now looking like you want to start encroaching into the broker's money, then you enter into what we call stop out. So stop out happens when the broker forcefully close those trades themselves. Okay, it's possible to actually leave this and it will just be running like that. Since you've not closed it, your balance is not going to change. There's some people will say, I won't close it now. Since if I don't close it, my balance will not change. I'll wait till the things turn around. Okay. But broker is never going to allow you to, the current losses you are having, your floating loss is losses that you have not closed, or your floating profit. Floating profit is profit that you have not yet closed. Okay, they are not trades that you have closed yet. So if your floating losses is getting to a level whereby it's encroaching to the broker's money, they will just stop you out, close all those trades forcefully, and that will just be it. So those are extreme levels of trading for people who are very, very, very aggressive. Okay, I hope you are not aggressive. I hope you want to take it cool and gradually, and build very sustainable income from this. Okay, so I just decided to let you understand what this three concept means, and I hope it makes sense to you. Okay, so now how do we calculate our profit now? how do we calculate profit, or how do we measure the loss? So profit is equal to the lot size you are trading multiplied by 1 pip value of the pair, of the currency pair you are trading, all right, multiplied by what you call take profit. Take profit is, we talked about pips. Take profit is when you trade, how many pips do you want to make, or how many pips do you make from that trade? I told you about pips to that time that we're going to use it to calculate profit. So like, how many pips do you make from that trade? That's it. So let's say, for example, you have someone who traded 0.5 lot size and of euro US dollar. 1 pip value of euro US dollar is $10. Once you make 1 pip on euro US dollar, it means $10. Okay. So let's now say you make 50 pips. So this is the lot size. You make 50 pips, but every pip you make means $10. Okay. So if you make 50 pips and 1 pip is $10, that's like $500 that you made. You now multiply it by the size of your trade. That's how you calculate profit. So in this case, the profit is going to be what? $250, right? That's going to be the profit. All right. So that's how you calculate your profit. The lot size multiplied by the pip value of that currency pair multiplied by take profit. Okay. I'm going to show you where you can easily see the pip value of the different currency pairs that we have. Okay. And the same thing for loss. Loss is calculated by this lot size. We're going to end this class very soon. Okay, somebody says it doesn't understand. Okay, let me break it down for us. Now, when you trade, if you buy, for example, at, let's say, this price level, when you buy, you're anticipating that the price is going to go up, okay, to a higher price level. So let's say when you bought here, price went up here. And the distance is what? Is 50 pips. That's going to be your profit. You buy here, and then you exit here. That means you're buying low and you're exiting higher. Or it could also be a sell. Let's say you sell here. If you sell at this level, you are anticipating that price is going to go down. And if price goes down and you exit at this lower level, unless the distance between them is 50 pips, you have made 50 pips. So you often hear traders say, I made 50 pips from that trade, I made 20 pips from that trade, and all that. So if you make 50 pips, pips is not dollar. We also need to know what the value of 1 pip is, right? Before we know what's going to be the dollar value. For euro US dollar, 1 pip is $10. So let me ask you, if 1 pip is $10 and you make 50 pips, that's how much? Can somebody tell us? Please write it. If 1 pip is $10 and you make 50 pips, that's supposed to be what? I'm waiting for somebody. $500. That's supposed to be the value. Thank you. Okay, that's $500. Meanwhile, this is not just going to be it. This is just the profit you're going to make if you trade one lot size. Okay, if you trade one lot size. So to know the final calculation now, because a lot of people can make 50 pips. Somebody with a big money can make 50 pips. Another person with big small money can make 50 pips also. But what is going to now, because they all make 50 pips, okay? But what's now going to determine how much they make is what? The size of the trade. Okay, this the quantity of that trade that they take. It's just like two people investing. Let's say they make 10% each return on their investment. The first person invests 100,000. The second person invests 1,000. What is the profit this person going to make? 10,000. What is the profit this person is going to make? 100. Meanwhile, they both make 10% return on investments. You understand what I mean? But this person invests more. So what determines the size of your investment is the lot size. So that's why you need to multiply this by the lot size. And that's how we're able to get to $50. If another person makes use of one lot size now, it will have made $500. Let's say with the same 50 pips. If they can trade the same thing, but the value, I mean, the quantity of their trade is what is going to determine what the final value of their profit is going to be like. Do we get it now? Okay. Okay, good. So, Omada, you understand that now. Beautiful. So, the same thing for loss. Because if you get the direction wrong, the market is also going to calculate the distance between the level that you enter and then the level that you exit. If you buy here now, thinking that price is going to go up and that price now goes down against you by 20 pips, and you ask the market to close, what happens there? You have lost 20 pips. So you want to buy, anticipating that the price is going to go up, but instead it fell by 20 pips and you close there. That point where you close is, let's say, 20 pips. This is where you buy, this is where you sold, bought here, so that subtract the two, multiply by 10,000 or 100 divided by what you trade, and then you get this 20 pips loss. So to calculate loss also, loss is also going to be lot size, this, multiply by 1 pip value, multiply by what we call stop loss. Stop loss is just the opposite of take profit. That is the amount of pips that you lose when you are in a losing position. So that's not going to be, also if it's 0.5 lot size also, that's going to be 0.5 multiplied by $10 and multiply by what? 20 pips. And that's going to be what? 100. So that means the person is going to lose $100. Somebody that traded with 0.05 lot, will he lose as much as that? No. He's going to lose $10. Somebody that traded with 0.01 lot will lose how much? $2. Somebody that traded with 10 lots will lose how much? 1,000. So it all depends on your account size. I mean, the size of your transaction and how much you make in terms of the pip value, how much you're able to take, and then how much you're using to take it. That's what is going to determine your profit and your loss. Do we get it? Does it make sense to us? And the pip value of each of these currency pair is different from the other one. Now, there's a website I'm going to show you now that gives you a table of the value of each of these currency pairs. So we call it the pip value table. So I'm going to share with you now, and I'm also going to drop the link so that you guys can see. Now, this is it, the pip value. These are the currency pairs. This is the pip value in USD. All of your account is going to be in USD. So you're going to use this one. If your account is in euro, you use this. If it is in pound, you use this. But you're going to deposit in dollar. So you're going to use this. So you can see the currency, but this is the pip value of each of them. All right. So Australian dollar, US dollar is $10. Euro, US dollar is $10. All those ones that end with US dollar, they are $10. All right. One thing you'll notice is that currency pairs that end with the same counter currency, they have the same big value. All those ones that end with US dollar, they are 10, $10. But those ones that end with Japanese yen, they are what? 7.58. 7.58. See this one? 7.58. No, this one is 7.5, it's Hong Kong. Okay, 7.58. 7.58. 7.58. Okay, so if I want to trade a currency pair that ends with, let's say I want to trade New Zealand Japanese yen, I don't need to look for New Zealand Japanese yen. I can just use Aussie Japanese yen because they will have the same peak value. Another good thing is this thing is arranged in alphabetical order. All right. Or you can just search. Let's say you want to check for GBP New Zealand dollar. Can you say I type it and it brings it out for me? Okay. So this is the peak value. So I'll just bring this peak value. If I want to do my calculation of whatever profit or loss, I'll just bring the peak value and bring it here. I already know the lot size and I know the profit I'm taking, or the lot size and the risk I'm taking. All right, that's how you can calculate profit and loss. Do we get that now? Okay, so this is where we're going to end for tonight. We're going to continue on Wednesday. We're going to take us through the MetaTrader 4 so that at the end of everything on Wednesday, we'll understand the trading platform, and then we can start placing some trades on a demo account to just practice. This is how I buy, this is how I sell, and all those things. So please make sure you don't miss that class. It's going to be very interesting and very educating. All right. So if you have any questions, please drop your question. Let me attend to them in the next 2-3 minutes so that we can close this meeting and we'll all go and rest. Do you have any questions? Okay, Victor says, do you have an ebook so that we can go over what you taught us? Yes, I can share ebook with you. Can get ebook for you. Okay, if you're on the WhatsApp group, I'm going to drop an ebook there or some ebooks that you can read. For those who like reading, for those of you who like watching videos, I'm going to send you the link to videos of the past classes and even this one so that you can watch over and over and over again. All right. Okay, do you get that, Victor? Do we have anyone with any other questions? Any other questions? All right. So I want to appreciate all of you who stayed to the end. I know some others have left because of network and all that. So thank you, Adeyemi. Thank you, Manuel, Omodayo, Sheyi, Victor, and every other person who stayed to the end of the class. So we're going to continue on Wednesday. Okay. Please make sure you don't miss it. Have a very wonderful night. Thank you.